Every day, investors search for opportunities. They study markets, read financial statements, follow analysts. But sometimes an opportunity doesn't begin on Wall Street. Sometimes it begins with something ordinary: a restaurant, a product, a line of customers, something thousands of people see every day without ever wondering about the business behind it. In the 1970s, one investor noticed something about a growing restaurant company. What caught his attention wasn't a stock chart. It was what was happening in the real world. But noticing the company was only the beginning. He investigated the business, studied its fundamentals, and saw an opportunity that others weren't looking for. Before long, that ordinary observation would lead to an investment, and an outcome that helped illustrate one of the most enduring principles in investing. But the investor's identity can wait. First, we need to understand what he saw. How did an ordinary restaurant become an investment opportunity hiding in plain sight? In 1977, a young fund manager took responsibility for a mutual fund. He wasn't yet an investing legend. He wasn't someone whose every decision attracted attention. He was simply looking for opportunities. But he had a particular way of looking. Rather than limiting his search to the companies already commanding Wall Street's attention, he believed worthwhile investments could be found almost anywhere. The more companies he examined, the greater his chances of finding something other investors had missed. Years later, he would describe the idea simply: turn over more rocks, look at more companies, ask more questions, investigate businesses other investors might ignore. And sometimes, the first clue didn't come from an analyst report. It came from everyday life: restaurants, stores, products people were buying, businesses growing quietly while most investors were looking somewhere else. One restaurant company caught his attention. It wasn't a glamorous technology company. It wasn't a Wall Street favorite. It sold inexpensive Mexican-inspired food from restaurants that were becoming increasingly familiar to American consumers. But the young investor wasn't interested simply because people were eating there. He wanted to know what was happening behind the counter. Was the business itself strong? Could the concept be repeated? Could it keep expanding? And was there an opportunity that the market had not fully recognized? Those questions transformed an ordinary observation into an investigation. And the company at the center of that investigation was Taco Bell. Taco Bell had begun with a simple idea: serve inexpensive Mexican-inspired food, quickly, through a restaurant concept that could be repeated. What mattered to the investor wasn't simply that customers liked the food. It was that the business appeared capable of working again and again in new locations. That distinction mattered. A successful restaurant could be a local phenomenon. A successful restaurant system could become something much larger. Taco Bell had already begun demonstrating that its concept could travel. The restaurants shared a recognizable format, a relatively simple menu, a repeatable operating model, and a product that could be introduced to customers in new markets. For an investor willing to look beyond the restaurant itself, those characteristics raised a much more interesting question. How far could this concept go? The answer wasn't obvious. Expansion brings risk. A restaurant that succeeds in one market doesn't automatically succeed in another. New locations require capital. Operations become more complicated. Management has to maintain consistency as the organization grows. So the young fund manager kept investigating. He wasn't trying to predict whether people would still want tacos next month. He was trying to understand whether Taco Bell possessed something much more valuable: a business model capable of reproducing its success. And the deeper he looked, the more interesting the company became. The more the investor studied Taco Bell, the clearer the opportunity became. The clue wasn't one spectacular number. It was the combination of several things. The concept was working. The company had established a good operating record. Its balance sheet was strong. And most importantly, there appeared to be much more room to grow. At the time he became interested, Taco Bell's success was concentrated largely in Southern California. The company was beginning to move into Central California. That raised a simple question. If the concept worked here, why couldn't it work somewhere else? For a restaurant company, geography could become opportunity. A successful concept didn't have to invent an entirely new product every year. It could take something that already worked and reproduce it in another market, then another, and another. But that possibility alone wasn't enough. The investor still had to determine whether the business underneath the expansion could support it. That is where the fundamentals mattered. A good operating record, a strong balance sheet, a concept that had already demonstrated customer appeal, and a business model that appeared capable of being repeated. The restaurant had provided the clue. The research provided the conviction. This distinction would become important to understanding the investor's philosophy. Seeing customers in a restaurant wasn't a reason to buy a stock. It was a reason to start asking questions. And after asking those questions about Taco Bell, he reached a decision. He was going to invest. The investor had found what he was looking for. Not certainty, not a guarantee. A business whose fundamentals supported the opportunity he had first noticed in the real world. So he invested in Taco Bell. And then, the story moved quickly. Taco Bell continued expanding. The restaurant concept that had attracted his attention was demonstrating that it could travel beyond its original markets. More restaurants opened, more customers encountered the brand, and the opportunity that had once seemed ordinary became increasingly difficult to overlook. Then, in 1978, something happened that changed the story. PepsiCo moved to acquire Taco Bell. The transaction was valued at approximately $125 million. Taco Bell shareholders were to receive 1.43 shares of PepsiCo for each Taco Bell share. And by the time of the sale, Taco Bell had grown to 868 restaurants. The little restaurant concept that had begun in California had become valuable enough to attract one of America's major corporations. But the acquisition wasn't what created the opportunity. The opportunity had existed before PepsiCo arrived. Before the transaction, before the outcome was obvious. Someone had already looked at the company, studied the business, and decided that what appeared ordinary deserved serious attention. The investment thesis had played out. But one question remains. We've followed this investor from the beginning. We've seen what caught his attention. We've seen how he investigated it. We've seen the decision he made. Yet we still haven't said his name. So who was he? The investor was Peter Lynch. In 1977, Lynch had taken over Fidelity's Magellan Fund. He would eventually become one of the most celebrated investors of his generation. But when Taco Bell caught his attention, the lesson wasn't about reputation. It was about where an investment idea could begin. Lynch believed investors increased their chances of finding opportunities by examining more companies, turning over more rocks, looking beyond the businesses everyone else was already discussing, and paying attention to what was happening in the world around them. Taco Bell was an example. The restaurants weren't hidden. The customers weren't hidden. The business wasn't hidden. What mattered was that Lynch noticed something ordinary and then took it seriously enough to investigate. That distinction is important. Observation can lead you to a company. But observation alone doesn't make it an investment. You still have to understand the business, study the fundamentals, ask whether the economics make sense, consider what could go wrong, and determine whether the opportunity you think you found is actually supported by the evidence. Peter Lynch didn't need information that nobody else possessed. He began with something millions of people could see: a restaurant, a growing business, an ordinary part of everyday life. Taco Bell didn't look extraordinary, but Lynch wasn't asking whether the restaurant looked extraordinary. He was asking whether the business might become extraordinary. So he investigated. He studied the fundamentals. He saw the potential for expansion. And he invested before the outcome was obvious. Years later, the Taco Bell investment leaves us with a question that reaches far beyond one restaurant company. If an ordinary restaurant could become an extraordinary investment, what ordinary business are investors dismissing today?